Oh, hi there, it's Lewis Forex, and I'd love to welcome you to this video. Before I go on, I'd love to thank my mentors, Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, Tim Sykes, who wrote the foreword to the book The Penn Stock Course, and finally Matthew Crater, who wrote the book Rocket Stocks. And now I'm going to share with you two powerful strategies that I discovered using Finviz. Now, when I discovered these strategies, it was really crazy. So it was actually by accident. So what I did was I said the price should be below the 50-day moving average, then the price should be above the 200-day moving average, and I used a pattern called wedge down, and something appeared, a price. It was Tesla. I saw the price of Tesla. So when Tesla stock appeared, a week after it appeared, there was an announcement in the news that Elon Musk, let me see if we can see the news here, but there was an announcement that Elon Musk had been gifted about $1 billion worth of shares in Tesla. And so it was during that time then I realized that maybe the strategy has legs. Let's see if we can find it here. So basically what happened was it was about like Elon Musk where's that news up? I hope it's here. But like Elon Musk had been given shares. I don't know if we can search for it. I don't know if we can search for it. But basically what happened was Elon Musk had been gifted shares. Oh my god, I hope I'll find it for you. Let's see if we can find it here. Alright, let me just pause the video. See if I can find. Alright, so as you can see, this was on the 4th of August. Tesla approves share award worth 29 billion to Elon Musk. So this is according to Reuters, and this is the one who covered the story. So Tesla grants 96 million new shares to Musk. Award vests only if Musk remains in key executive role for 2 years. New shares will be fortified if court restores Musk's voided 2018 pay package. Stock rises 2% as analyst says it removes uncertainty over the future. So so it was way before the stock rise. Alright, so there was a stock rise of about 2%. The company described the interim award of the 96 million new shares as first step of good faith payment to honor Musk's more than 50 billion pay package from 2018 that was struck down by Delaware court last year. So basically what it is he was offered a pay package, but the court refused. And so instead he has been awarded the equivalent in shares, or half of his pay package in shares. The move is meant to keep Musk, the public face of Tesla and the architect of its robo-taxi strategy, focused on the electric vehicle maker as it navigates the shift to cybercabs and robotics for its mainstay auto business. Sales have been falling at the company due to its aging vehicle lineup, tough competition, and Musk's right-wing political stances that have tarnished its brand. Alright, so basically he was granted this. So listen, the Delaware roar on Musk's 2018 pay package, the largest in corporate America, had cited flaws in the board's approval process and unfairness to investors. Musk kicked off an appeal against the order in March, claiming a lower court judge made multiple legal errors and shrinking the record compensation. He has argued that the package resulted in spectacular growth for Tesla and yet determined by the lower court of to be unfair to shareholders who voted twice to approve the package. So Tesla shares have risen 2,000% over the past decade, far outperforming around 200% rise in the benchmark S&P 500 in the same period. So basically, Elon Musk was given this huge pay package, right? But the court ruled against it. The Delaware court ruled against it. So the suspicion is because of his endorsement of Donald Trump. The Delaware court judge seems to be favored by the Democratic Party of the state. So because of this, they ruled against him to receive that pay package. But then also you will find that despite that, he has been granted shares by the board. The board has given him 29 billion shares, and which he has accepted. So that's the news package I wanted to show you, because it is very important to understand that these strategies are very much connected. I'm shocked I have not seen it here, but Reuters did cover it. Okay, on the 4th of August. So anyway, so that's where the move came from, and when I saw that, I couldn't believe it. So it was in that moment that I realized that maybe the strategy holds water and truth to it. I won't lie, the strategy kind of shocked me because of the wage pattern. So let me just pause the video so that we can do research on this type of pattern. Alright, so we're here on stockcharts.com and we're looking at the falling wedge. So what is the falling wedge pattern? The falling wedge pattern is a bullish pattern that begins with wide at the top and contracts as price moves lower. So wait, what's happened to my highlighter? Sorry guys, let me just get my highlighter working. Okay. All right, so the falling wage pattern. Okay, what's happening here? Okay, what just happened? All right, so sorry about that. So the falling wedge pattern is a bullish pattern that begins so the falling wedge pattern is a bullish pattern that begins wide at the top and contracts as price moves lower. Now this price action forms a cone that slopes down as the reaction highs and reaction lows coverage. Now in contrast to the symmetrical triangles, which have no definite slope or bias, falling wedges definitely slope down and have a bullish bias. Okay, now this is very important to remember because that's how the strategy is. This is exactly how the strategy is. So basically it's a falling wedge pattern, right? And then it's found its support on the 200-day moving average, right? So the pattern is called the falling wedge pattern, and then the support is on the 200-day moving average but below the 50-day moving average. And this is exactly what happened with Tesla. So is Tesla still a good buy? I don't know. I think so. I think there's still space for it to run. So whether it's a good buy or not, I am really not sure anymore. But finding the wedge down pattern was something awesome. I think what I love about Finviz is it's a little bit more accurate compared to TradingView. Now I know TradingView. I love TradingView because you know it is a very awesome place. I don't know if we can find. Anyway, while Finviz is loading, I love TradingView because it's a very awesome place. But there's just something about Finviz stock screener which is awesome. So while it's loading, let's look at the falling wedge pattern. So is the falling wedge a reversal continuation pattern? While this article focuses on the falling wedge as a reversal pattern, it can fit into the continuation category. So this is an example of a falling wedge pattern, and then we have high volume here. Alright, so we have this is the chalk and money floor, and then we have high volume appearing right here on the falling wedge pattern. Let me just reject the cookies here. Right, so this is exactly what happens. So I want to show it to you. Okay, I don't know why it's taking long, guys. All I want is the Tesla. Alright, let me just pause the video. I'm coming. Alright, we're back. So I think I found a better way to find Tesla now. I was trying to explain to you about the pattern. So remember we're talking about this pattern right here, the falling wedge pattern. So this is exactly what happens right here. So it falls down right like that, right? Then it hits the support, then it goes up according to the volume, right? So this top line here represents the 50-day moving average. This represents the 200-day moving average. So what are the characteristics of a falling wedge? To qualify as a reversal pattern, there must be a prior trend to reverse. Ideally, the falling wedge will form after an extended downtrend and mark the final excuse me. Wait, where's my highlighter? My highlighter keeps going off. Sorry, guys. I need to use it over and over again. I don't know what's happening to my highlighter. Okay, so to mark the oh my goodness, what's happening to my highlight? Okay, what's happening to my highlighter? So basically, alright, just a second, guys. I don't know. Okay. Here we go. Wait. Come on. I don't know what's happening to my highlighter. And what's happening to my highlighter? There we go. I hope my highlighters have not. My highlighters have been removed. Anyway, so it marks the final low. Now the pattern usually forms over a 3 to 6 month period, and the preceding downtrend should be at least 3 months old. Now this is very important, right? So This is why it has to be below the 200-day moving average. All right, now let's jump into Tesla. All right, now, so this is exactly what happened with Tesla. I'm failing to see the 200-day moving average, but I basically saw it somewhere here, and then it just popped. It just popped, and I couldn't believe it. I don't know why I'm having difficulty seeing it here, but let me give you another one. I think it should be ABT. Abbott Laboratories. But that's what happened with Tesla, right? So you can see the falling wedge pattern, then it just pops out, just like that, and then it reverses. So the falling wedge pattern really is a reversal pattern. Okay, so basically we're waiting for it to reverse below the 200-day moving average. Now remember what it said. It said the reversal pattern should be about 3 months, 3 to 6 months old. Now 30 times 6 is about 180 days. So that's why it is very important for the price to be below the 200-day moving average. So this is exactly what happened to this price yesterday. So the price was actually below the 50-day moving average, and the pattern formed here, the falling wedge. So this is a perfect example of a falling wedge pattern. So the pattern fell down, right? This was a falling wedge, and then it was between the 200-day moving average. Now remember, the move has to be about 3 to 6 months old, then it qualifies. And that's why even on the screener, oh yeah, and by the way, if you want to dive deep into the charts, try Elite free for 7 days. No credit card required. I think there'll be a link. I will put an affiliate link to Finviz below this video. So that's the strategy right there. So I remember I bought Industries was one of them that I saw, but it is important to remember this. The downtrend should be at least 3 months old, 3 to 6 months, right? 3 to 6 months. My highlight off. Okay, still on. So this pattern usually forms over 3 to 6 months period, and the preceding downtrend should be at least 3 months old. So now the upper resistance line, it takes at least 2 reaction highs to form the upper resistance line, ideally 3. Each reaction high should be lower than the previous signal. So like rising wedge, the falling wedge can be one of the most difficult chart patterns to recognize and trade accurately. The security is trending lower when lower highs and lower lows form, as in a falling wedge. So the falling wedge indicates decrease in downside momentum and allows investors and traders to potential trend reversal. Even though selling pressure may diminish, demand wins out only when resistance is broken. As with most patterns, waiting for a breakout and combining other aspects of technical analysis to confirm the signal is important. So as you can see here, this is like the support level right there. So it hit the support level, then it broke out, kind of similar to what happened with bot technologies. So this is the pattern. Remember, the price has to be above the 200-day moving average but below the 50-day moving average. Now I purposely focused on the S&P 500. Right, I focused on the S&P 500 on purpose. I focused on the S&P 500 on purpose. But let's see, maybe we could try and see if we can find the pattern on any other market. Now the reason why I traded the S&P 500 because it's the most common market on most brokers, on most future trading brokers like capital.com, for example. But finding a pattern like this has been really humbling. So with the overall market, let's look at one which has at least a volume of $1 million or more. Let's see what we have here. So all these are just examples. And they are not very accurate, but they're just examples of the falling wage pattern. So we'll look at this one here as an example. So the bottom line, the falling wedge pattern is a bullish pattern. Alright, the falling wedge pattern is a bullish pattern that suggests potential upward price movement. This pattern, while sloping downward, signals a likely trend reverse or continuation, marking a potential inflection point in trading strategies. Falling wedges can develop over several months, culminating into a bullish breakout when prices convincingly exceed the upper resistance line, ideally with a strong increase in trading volume. The following which can be valuable too in your trading arsenal, offering valuable insights into potential bullish reversals. And this is the key. You want potential bullish reversals. However, it's important for you to have a good understanding of this pattern in order to effectively leverage it in a live trading environment. So this is the pattern that we are using, the falling wedge pattern. I don't know what this represents, but I'm assuming it represents the mark D line. Then we have the Chaukan money flow here, which goes up as well. So it's definitely a reversal pattern, something for you. So this is a positive divergence on the mark D line here. Right, so we have, I don't know what that is, but you can see the falling wedge pattern right there. And then it's been signaled by because remember it's right below the 50-day moving average. It's right below the 50-day moving average, and so you can see the breakout is about to appear right there. So if you enter right here, it should break out. Okay, so that's how powerful this strategy is. It's a very, very powerful strategy, and I found it using Finviz. Again, there should be if you want clarity on your charts, there should be an affiliate link below the video. So that's the falling wedge pattern. The second pattern that I found also something that surprised me. I'm still testing this one out because with this one I used the descending triangle. So let's pause the video. Alright, so this is the second chart pattern. It is called the descending triangle. Let me see what we have here. Okay. So basically it is a bearish chart pattern. Okay. Now the way I used the descending triangle, I used it in an uptrend. So I used it as a form of a bear trap. So basically what happened was it forms like a bear trap. So the idea was this price crashed from an uptrend. Okay, the price crashed from an uptrend and then it halted because of traders sentiment, right? So traders were kind of like doubting, and so it halted, and that's where the spinning top came in, because I used the spinning top to halt the downtrend. So look at this. So it halted, right? So it's like the pattern was downtrending on the descending triangle, right? And then it halted. So that halt, we're gonna use this one as an example. So that halt was determined by a spinning black white top. So it halted from an uptrend standpoint, right? So the descending triangle is bearish bias, right? But the way I used the bearish biasness was I looked at it from a standpoint of a bear trap. I looked at it from a standpoint of a bear trap. Trying to get my highlighter to work. I don't know why it's failing. Come on. Man, what's up with my highlighter? Maybe we can even change the color. Yellow is the best. Man, come on. What's happening to my highlighter? My highlighter is tripping. It was blue. It worked. It actually worked. Oh my goodness. I'm struggling with my highlighter, you guys. All right, one click. So these lower highs are indicating increased selling pressure and give the descending triangle its bearish bias. So we're gonna look at an example of how I found this strategy, which was very funny and interesting. So you can see it's right here. So that this pause right here, it's like the end of the crash. So I call it, it's like a bear trap. So imagine the price is coming down and then it gets trapped. It's like just gets halted. Then the move just stops moving, right? It just stops moving and it reverses. So it's like a hard reversal. It's very it's very similar to the wedge down. The only difference is with the wedge down pattern, the price reversed on the 200-day moving average. Now with the descending triangle, the price reverses on the 50-day moving average, and that's why this pattern is very powerful. So feel free to rewatch this video so that you can copy the pattern. So basically the price has to be above the 50-day moving average and the 200-day moving average, and then the pattern should be a triangle descending, not strong, just triangle descending with your spinning top white. So the spinning top white gives you that pause, right? It gives that pause in order for you to enter the position. Now I won't lie to you, I found these strategies using TradingView, because TradingView did actually help me see exactly what I was looking for. But this is what happens in the descending triangle. The descending triangle is not a notable technical analysis pattern that indicates a bearish market. It forms during a downtrend as a continuation pattern characterized by a horizontal line at the bottom formed by comparable lows and descending line at the top formed by descending peaks. Alright, so it is a bearish pattern, but imagine using it as a bear trap. Okay, and that's how I used the pattern. I used it as a bear trap. So I'm gonna show you one last thing before we close out, and what made me discover this pattern. So we're gonna take note of this, right? Let me take note of it. FFAI. Let me pause the video and switch to TradingView. Okay, so we've switched to TradingView, and they're just waiting for it to load. Switch to super charts, but meanwhile we can study the descending pattern. Now the descending triangle is a bearish formation. It generally forms during a downtrend and is a continuation pattern, although sometimes a descending triangle forms a reversal pattern at the end of an uptrend. Regardless of where they form, descending triangles are bearish patterns that indicate distribution. Now, because of its shape, the pattern can also be referred to as a right angle triangle. Two or more comparable lows form a horizontal line at the bottom. Two or more declining peaks form a descending triangle line. Right, let's check it out. I've already written the ticker down. It's FFAI. Now if both lines were extended right, the descending trend line could act as a hypotenuse of a right triangle. Now there should be an existing trend. To qualify as a continuation pattern, an established trend should exist. However, because the descending triangle is a bearish pattern, The length and duration of the current trend are less important than the robustness of the formation. Okay, let's see if we can study it a little bit further. So upper descending trend line, at least 2 reaction highs are required to form the upper descending trend line. These reaction highs should be successfully lower, and there should be some distance between the highs. If a more recent reaction equals or exceed the previous reaction high, then the descending triangle is invalid. The length of a pattern can range from a few weeks to many months, with the average pattern lasting from 1 to 3 months. Are you seeing this? Very similar to the wage down. So a basic tenet of technical analysis is that broken support turns into resistance and vice versa. When the horizontal support line of the descending triangle is broken, it turns into resistance. Sometimes there will be a return to a renewed resistance level before the down move begins to earnest. Okay, so let's see what we have here. Alright, so I think we can close this. So basically the descending triangle is a bearish pattern. Now the main reason why I chose this pattern is something called a bear trap. Now what you need to understand about the okay, me and TradingView are beefing right now. Alright, let me just pause the video. I'm coming. Alright, so I'm using a TradingView app. So let's see what we got here. So this is an example of what I was trying to show you of the first strategy. Which has the wage down. All right, so this is the first strategy, which was the wage down. Okay, let's look at it. Now you can kind of see the way it trended downwards, right? And we're about to break the bear's back with this green line. So once this green line passes, right, then it's going to blow up. So that's what I wanted you to see. Man, this is crazy. All right, this just a second. But yeah, but basically this is what happened. Okay, let's do that. So basically we're using the simple day moving average, right? So basically it was below the 50-day moving average, and then the price was right there, right below the 50-day moving average, which is what we was expecting, right? So it was right below the 50-day moving average, and then it just gapped up, right? So that was yeah, I think that was one of them. This was also another one. It was the same chart pattern. Alright, it was the same chart pattern. The same chart pattern. Okay. um Even though the market was flat, yeah, but it was the same chart pattern. It was the same chart pattern, and it was just interesting to see that happening. So I wrote down the now this is the second chart pattern of the descending triangle, the bear trap. And I wrote down the ticker so that we could see it. Now this is powerful to note. This is definitely an oversold market, but something just told me, it's the one. So yeah, this is the descending triangle chart pattern. So this is how it looks like. But these two confirm the continuation. Chart pattern using the wedge down. So maybe the descending triangle is not the correct chart pattern to use right now. But I'm still testing the descending triangle, but the wedge down chart pattern is definitely a good one to go for, and these two are perfect examples of the descending triangle chart pattern. Okay, these are perfect examples to show you that the descending triangle chart pattern definitely works. And the cool thing about it is you can use the 50-day moving average as your entry. No, not the descending, the wedge down. You can use the 50-day moving average as your entry. Right? You can use the 50-day moving average as your entry. So the key is definitely to watch out for this pattern. Well, I'd love to thank you so much for watching this video. Take care. Bye bye, and bye bye.